Hash crypto in your portfolio. How much is too much? Okay, real talk. I just watched someone lose $40,000 in crypto in 3 hours. And you know what the worst part was? They thought they were being smart about it. They had 5% of their portfolio in crypto. Sounds reasonable, right? Wrong. Because that 5% was on margin. That 5% had leverage. That 5% wasn't actually 5%. It was more like 30% of their real money once you did the math. And that's the crypto trap nobody talks about. Welcome back to the channel. If you're between 22 and 45 and you're trying to build actual wealth, you need to watch this because I'm going to show you exactly how much crypto should be in your portfolio. And spoiler alert, it's probably less than you think. Let's start with the uncomfortable truth. The average American investor who owns crypto has about 12% of their total portfolio in digital assets. According to recent surveys, that number jumps to 20% for investors under 35. And here's what kills me. Most of these people have no plan for when to sell it. Think about it. You probably have a Robinhood account with $3,000 in Bitcoin. You have a Coinbase account with another $2,000 in Ethereum. Maybe you threw $500 at some altcoins your coworker mentioned. But do you have a strategy? Do you have an actual number where you say, if this hits 20,000, I sell half? Most people don't. And that's the difference between investing and gambling. Here's the framework I use. And it's based on actual financial principles, not Reddit threads. Part 1. The Foundation First Rule. Before you touch crypto, your foundation has to be solid. I'm talking non-negotiable. You need a fully funded emergency fund. 3 to 6 months of expenses sitting in a high-yield savings account earning 4.5% right now. If you make $4,000 a month and your expenses are $3,000, you need $9,000 to $18,000 liquid. That's not in crypto. That's not in stocks. That's in cash. Next, you need to be maxing out your tax-advantaged accounts. Your employer's 401k up to the match. Minimum. Better yet, up to $5,500 a year. Your Roth IRA filled up with boring index funds. Total stock market. S&P 500. This is not sexy. This is wealth building. I'm talking to you specifically if you're 28 with a decent job. You should have 6 months of emergency fund plus $4,000 in your 401k before you own a single Bitcoin. The math is non-negotiable. Only after those foundations are locked in does crypto enter the conversation. Part 2. The actual number. Here's what I recommend. And this applies to someone making $50,000 to $100,000 a year. Crypto should represent 3 to 5% of your total investable assets. Not your house. Not your car. Your investable assets. That means your brokerage accounts. Your retirement accounts. Everything liquid and in the market. Here's what that looks like in real dollars. Say you have $100,000 in investable assets. Your portfolio might look like this. $70,000 in index funds through Fidelity. $15,000 in your Roth IRA in S&P 500. $10,000 in your 401k. $3,000 in crypto. That $3,000 stays in Bitcoin and Ethereum only. Not some random token your buddy is hyping. Not DeFi experiments. Not altcoins. Bitcoin and Ethereum. That's it. Why 3 to 5%? Because even if crypto goes to zero, and yes, that's possible, you've protected your wealth. You're not devastated. You still hit your retirement goals. Now, if you're more aggressive and you're under 35, maybe you go to 7%. That means instead of 3,000, you've got 7,000 in that $100,000 portfolio. But here's what you don't do. You don't margin trade. You don't use leverage. You don't put money in crypto that you might need in the next 5 years. Part 3. The rebalancing rule. Here's where most people mess up. You buy crypto. It goes up. Now it's not 3% anymore. It's 12% because Bitcoin went crazy. So what do? You rebalance. You take those gains. You sell enough crypto to get back to your 3 to 5% target. That money goes into your index funds. This feels terrible. I know. You're selling the thing that's going up. But this is how you actually become wealthy. You're mechanically taking profits. You're locking in gains. You're following a system instead of your feelings. Do this once a year. Every January. Look at your accounts. Do the math. Rebalance back to your target. That's it. That's the system. The bottom line. Crypto is not your wealth builder. Your boring index funds are. Your Roth IRA is. Your disciplined savings rate is. Crypto is the fun money. It's the lottery ticket you can afford to lose. Treat it that way, and you'll actually build real wealth. If this framework helped you, please hit that subscribe button. We drop videos every week on portfolio strategy, real estate investing, and how to actually get wealthy as a regular American. Thanks for watching, and I'll see you next time.